Good day, my name is Larry Short. I'm a volunteer with CPA Canada Financial Literacy. Today we're here to discuss understanding financial statements. So this will take about an hour, and I just want to emphasize a couple of things before we really begin. One is that there may be pieces of jargon in here that from time to time I'll use. If indeed I do use jargon that you don't understand, please raise your hand. There's no such thing as a silly question when it comes to this type of a discussion because it's about money. It's more important that you understand about this, about the various aspects of your financial statements than anything else. And don't be embarrassed if you think that is a silly question. Really, it's a failing on my part when I start using jargon that is used in our industry, which sometimes it causes confusion in the room. So I certainly don't want that to be happening. The second thing before we really get into it is the fact that many small businesses in particular operate in the first couple of years without financial statements. Now, the reason being is that an individual who's starting up a business, there's so many priorities and there are so many things that have to be done in order to keep that business going that often they delay preparing the financial statements because it seems to be something that will be done when I have the time. You really want to make your life as simple as possible. Prepare the financial statements within the first year and stay on top of them, because if you don't have the financial statements, you can't prepare your tax returns, and in the absence of the tax returns, you could cause your company to really get in trouble. So common questions business owners ask is, how is the business doing? And the best way to understand how the business is doing is to have these financial statements prepared, because this is your report card. And quite frankly, you should be looking at this report card, your financial statements, on a quarterly basis, certainly on a semi-annual basis. You're trying to find out, did you make money this quarter, this year, or the like, and this is the easiest way to be able to report it. Again, many people, when starting out a business, often will just look at the balance of the cash in the bank as opposed to what the financial statements are actually telling them. You also need to know what a profit and loss statement is. A P&L is what we call it in the business. What does that information tell you, and why is it that the P&L, the profit and loss, will tell me one thing and the cash in the bank may not necessarily align up with that perfectly, and it won't in 90% of the cases. People say, well, why do I need a balance sheet? We'll get into that in a bit more detail, but basically it tells you where the company is at a particular point in time, what assets it has, what liabilities it has, and what your net figure is. Where is my cash coming from, and where is it going? So this is cash management, and again, for small business owners, usually when you hear of a business failing, more often than not, it's because the cash didn't get managed. So you may very well have a large contract with the government that you just completed, and it was, say, $2 million, but if the cash in the bank won't support the payout from the government, which may take 90 days or 100 days or 200 days, then the company cannot survive during that period of time. So you need to know where your cash is coming from and where is it going. And again, that whole point in the end is, why isn't the cash equal to what the cash level in the bank equal to what my profit and loss statement is showing me? So three main statements that you want to be concerned with. Profit and loss, also called the P&L statement, and also, just to make life interesting for you, it's also called the income statement. It's also called the earnings statement, right? So again, watch the jargon in our business, and if in doubt, interrupt whoever is talking to you and say, what are you talking about there? And don't be afraid to do that. Particularly in early years, it's really important that you have an understanding of what these statements are, because if they're the guidance that you need in order to run the business, and there's any confusion whatsoever, it can lead you into trouble. The cash flow statement is where's the cash coming in and what cash is going out, okay? So that is the sources of the cash, as well as a statement of the uses of the cash. And then the net between is what should be in your bank, okay? So it's also called a statement of changes in financial position. Use cash flow statement, just use sources and uses statement. That's the easiest way to understand it. And then what's your balance sheet, and what's on the balance sheet, and how is it layered out. So these various names that you're seeing here are used by different financial professionals interchangeably. A key for you, again, is to break through the jargon, understand what these things are about, and that will lead you quite nicely in your business. So understanding the profit and loss statement. So basically this compares your revenue and expenses. So in the simplest form, it's revenue, how much income is coming in. And again, revenue and income is not exactly the same, but revenue is the gross sales. Okay, so what's the cash that's initially coming in the door. Of course, you've got expenses in order to create that revenue. And the difference between the expenses and the revenue is what your profit is going to be. So we're going to break that down in more detail as we proceed. The profit and loss statement has to be prepared according to accounting rules. So there are a series of accounting rules that we as accountants study over the years. We have to pass exams to show that we have proficiency, and that takes a good number of years in order to get through all of the rules and all of the exams. And one key aspect for your concern is that revenue may be recognized before the cash is received. So if you send out a bill to the government for $2 million, and because you've completed a contract, then that revenue will be recognized now. The cash may not come in for 180 days, maybe for 200 days or even longer. All right? Expenses had to be accounted for before the cash is paid. So in completing the contract, you may still have some bills that had to be paid, but you have to recognize the expense in this period, not when the cash was paid out on the bill. And the reason why this is done is because cash can be paid out 30, 60, 90 days, 180 days, or 2 years later. What we're trying to do is make a standard comparison so that you can see how you are doing compared to others, so that we can properly account for all of these transactions as well as the expenses. And then that allows us also to take that information and put it onto your income tax return. Okay? Now, profit will differ from the cash in the bank again because of these accounting rules, right? So if you have not paid bills, your cash in the bank is higher than what would be showing as being expenses on your profit and loss statement. Okay? If you have not received income, it'll be the cash in the bank will show as different because you have billed for something that you've recognized the revenue on, but the cash is not into the bank. So the difference between when revenue is recognized before cash is received and that expenses are recognized and recorded before you've paid the bill, it's called accrual accounting. And several people have joked that it is a cruel way to account for something, but, and now you'll remember it, but accrual accounting means recognizing the revenue in the period that the revenue was billed, not necessarily when it was collected, and recognizing the expense in the period that the expense was occurred and not necessarily when it was paid. Okay? So that's accrual accounting, and it's a key factor in understanding financial statements. So the primary categories of revenue and expenses. Well, revenue comes from sales activity in some form, contract activity, sale of a house, sale of equipment, whatever the primary business that you have selling to your clients, to your customers. The operating activities is the expense of actually operating the business itself, and these expenses can be also non-operating activities. So they're often things such as interest that you're going to be charged on your loans. It's going to be income taxes that are going to be paid on your profits. It's going to be one-time, unique, otherwise not occurring events. So you may, for example, discontinue a product line, and that would be, this product line might have been on the go for 20 years and suddenly it's become obsolete, but there's a cost of, dismantling all of that equipment, shutting down the warehouse. There might be severance packages paid out to employees that are one-time events that are not necessarily part of the overall operating revenue. So let's look at the profit and loss statement that's shown on the screen here. What we have is revenue of $100,000, cost of goods sold is $36,000. So the gross profit, not the net profit now, gross profit is $64,000. At this point, you can turn to the audience and ask them to select a local business in the area. It could be something like a Skidoo dealership, for example. And so their gross revenue would be sales from Skidoos. They may have also a maintenance revenue from Skidoo maintenance. They may actually have other things such as sale of gas and the like. So it gives you an idea of you can go down through and say, what would the revenue figures be, revenue sources be for this company? Now, what would be the costs? The cost would be, of course, the cost of Skidoos, the cost of salaries for the salesmen who are selling it, other direct costs that may come into the cost of gasoline, right, the cost of oil, and then they would go to their gross profit. So the idea is to find out what the direct costs, the direct revenues are, what the direct costs before you get into effectively overhead, okay, or other fixed costs that may be within the firm itself. So once that you calculate the gross profit, we now want to move into operating expenses. So these are the selling expenses, as well as things such as any research and development that's being done. So if it's a manufacturer, it's pretty clear that that if you have Nike sneakers that is in a plant and you want to find an improvement on the last sneakers that you used, you'd have research and development costs that you run into there. General and admin expenses are things such as the salaries of the admin staff, the payroll personnel, individuals who, everything from janitorial services to insurance on the building, okay? Then we get into elements such as depreciation, and this is really a little bit of a tricky one because and we'll deal with this more when we talk about the cash flow statement, the sources and uses statement. So depreciation is the wear and tear that arises from effectively the hard assets that you own, the things that you physically have to lift in order to have in the business. So if you have equipment, that equipment is going to wear out over time. Now you bought it maybe a year ago and you spent $1 million onto it. And you think it's going to last 5 years, so it's going to wear out at a rate of say $200,000 per year. Well, that effectively is your depreciation. So that's what that figure is there. It's the wear and tear on equipment that eventually will have to be replaced. And it can include wear and tear on the building itself, wear and tear on the tools that you have. So that's what that depreciation line is discussing. And so once that you deduct those operating expenses, you then have a total operating expenses. In this case here is $44,000. And then you arise down to an operating profit. So again, back to the profit and loss statements, we see it. We determined what the revenue was, $100,000. We determined what the cost of goods sold is, which is $34,000. Gross profit is $64,000. At that point then, you start deducting your operating expenses, such as your selling expenses, research and development, general and admin, and depreciation, and that comes to $44,000, leaving you a operating profit of $20,000. We still have some other things to discuss, before we get to profit and loss. To determine how much a business made this year, the operating expenses should be deducted from the operating profit, and the non-operating income should be added. All right, so what's the non-operating activities? So this includes interest payments, income tax payments, as well as one-time non-recurring items such as profit or loss from the sale of an asset or expenses associated with a major reorganization or a write-down of inventory. So if indeed you are in the food line and you have in the business of shipping canned goods, for example, such as milk or vegetables that are canned, and there's a best before date on these products, and for whatever reason these are held or lost or otherwise not shipped in time, then and goes past the best before date, you may be prevented from selling that product whatsoever. That would result in a write-down of the inventory, and that's where this thing is charged on these lines here. Similarly, income tax payments have to be paid out on a regular time. And then profit and loss from the sale of an asset. So this could be something such as when you built your warehouse, you decided that you would build on 2 acres of the 4 acres that you had. So you had raw land to one side. That raw land is going to be recorded as an asset in the company, as being owned by the company. And if you bought it 10 years ago and then suddenly you received an offer from a neighboring company to buy it for 50% more than what you think it's worth, then you're going to have that profit arise as a one-time, non-recurring item on your income tax statement. You identify it as non-recurring because you don't want to raise the expectation of people who read the statements, such as bankers that are providing finances, that your revenue has suddenly leaped by this huge amount and it's going to continue. It's a one-time element here. The bottom line on the profit and loss statement is known as net profit, also known as net income, and generally referred to as bottom line. Okay? So picking up on our example, we had left off where we had operating profit of $20,000. Now we have interest of $4,000, so that's the amount being paid on various loans and the like, the cost of borrowing money. And we also had $5,600 of income tax that was paid from the operating profit, giving us a net profit of $10,400. So let's move now to the balance sheet. So the balance sheet basically is what the business owns. And that compares to what the business owes. Okay? So before we go any further, I just want to understand what the business owns is cash that's in the bank, money that customers owe or called accounts receivable, inventory of what has been bought with the cash so far. So again, if you're a food company, it's all those canned foods and the like that are stacked up in the warehouse. Plant, the warehouse itself. Property would be the land that the warehouse is built on. And equipment, the various trucks, the tools, the lifting equipment and the like, in order to handle the actual equipment itself. What the business owes is it owes two groups. The business owes to money that is owed to vendors, which is accounts payable. So these are bills you haven't paid yet. And money owed to lenders. So that would be banks or credit unions, wherever you borrow the money from in order to run the business. The other entity that the business owes money to is the owner. So the money that the owner initially put in to the company, okay, plus any profits that haven't been paid out yet. So understand that the balance sheet, these two have to be in balance. That the assets must equal what is owed to creditors and owed to owners. And that's why it's called a balance sheet. At this point, go back to the example you started to work with, where you asked for the name of a local company and imagined what this company would have as assets and liabilities. So again, if we're talking about a snowmobile company, the assets would be the showroom, plus possibly a warehouse for storage, plus possibly a repair area for storage. Could all be in the same building. It would be the land that they owned, or maybe they leased it, so it's not really an asset there at that point. But you can go into detail so that people can envisage what a local business is, type of assets and liabilities that it would have. So in understanding the balance sheet, let's look at a couple of things. A balance sheet is a snapshot of where the business is at any one point in time. So it means it's prepared as of a particular date. So it can be either a quarter, or you can do it monthly. You can do it even with technology these days. Believe it or not, companies like Walmart know exactly what revenue was created for the whole company in the entire planet. At the end of the day, they know what their revenue is and they know what their cost of goods sold is. So they don't know all of the details, but they know a large amount of it, and that allows them to consolidate at the end of the quarter in order to quickly understand exactly where they are at that point in time. Now, the assets and liabilities are carried at what's called historic value. So meaning that remember I talked about how the business had 4 acres of land, they only used 2 acres of land to build on, they had vacant land next door, and they were offered 50% more than what they thought it was appraised at. That appraisal figure may not appear anywhere on the balance sheet. You had to be careful with this. So it is recorded at the lowest of what's called cost or market, okay? The lower figure. It doesn't allow you to increase the value of that vacant land in any way that can be recognized on a balance sheet. So that should underscore to you that the land that you bought 10 years ago, even though it might have been worth $200,000 when you bought it, might be worth $1 million today, but you'll not see that on the balance sheet until you get that one-time event happening where it's sold. So this is a real key part. Assets and liabilities are recorded at historic value. Physical assets are depreciated. So the equipment needed to load and unload, the trucks that needed to carry and the like, they are depreciated over time. So they'll be showing as being the cost of buying the equipment less depreciated value. Okay, so depreciation is, as we showed on the statement, is shown as a specific line on your balance sheet. Okay, and historic values may be significantly different than market values, as I was discussing earlier. So it's one key element that we want in there. Let's just discuss intangible assets for a second. This is really another key element that is not shown on your balance sheet. And where it comes up is that these intangible assets are things like patents, trademarks, and more often than not, it's brand name recognition. So I've often had clients say, here's my financial statements, here's my balance sheet, but my company's worth a lot more than that. And I say, well, why is it worth more than that? Well, we have a particular process that nobody else has. Or we have tremendous loyalty from our customers, which is brand name recognition. So don't be surprised if in your particular case, as you build your company over the years, that the balance sheet may actually understate what the true value is. In order to establish what the true value is, if you're considering selling it or the like, you hire a certified business valuator, and that's a separate topic. But just be aware we're talking accounting here and not necessarily the sales value of the business itself. Depreciation doesn't require cash, and this causes some confusion from time to time. It's what is called a non-cash operating expenses that allows the business to deduct the value of the wear and tear on the equipment. So as we discussed before, if you bought a truck that costs $100,000 and it's going to work for 5 years, and at the end of 5 years it's going to be worth zero, it means that you're wearing out $20,000 worth of that truck per year. Okay? The same sort of thing for forklift equipment, for any other physical piece of equipment that you're using in the business itself. For hair cutters, it may be scissors, but understand it is the wear and tear that's there. Each year, the value of the asset is depreciated. The balance sheet shows the cost of the asset less the total depreciation year to date. So in year 4, you would have deducted $60,000 at the beginning of year 4. At the end of year 4, for this truck, you would have been deducting another $20,000. So on the net on the balance sheet, it would show $20,000 as the net undepreciated value of that particular asset. The profit and loss statement shows the annual depreciation as an expense. So even though the cash didn't go out the door, it meant that you attributed this expense to this year. So in examining the balance sheet, we're looking at current assets being cash, inventory, and accounts receivable. Now, current assets means what you have to pay currently. That has to be paid within the year. So that's why it's called current. It's meaning almost present or immediate within the next period of time. The fixed assets are the plant and property equipment less the depreciation. So think of plant as being planted into the ground. It is the property itself. It is the equipment that you need to operate. It is basically anything that's too heavy to lift, or it'll hurt your toe if you drop it on it. Okay? So it's the physical assets that are there. And this is the way that the statements are typically laid out. So on the right on the screen here, we see an example of a balance sheet. In our example, the business has $25,000 of cash, so that's what's in your bank account, $20,000 of inventory, essentially that's what's in your warehouse, $15,000 of accounts receivable, so this is money owed to you by customers. So total current assets are $60,000. This is money that effectively is currently available and expected to be collected as part of the accounts receivable. Fixed assets include $50,000 of plant, so that's the building itself, there's there. Property would be the value of the building and the land, and equipment, and that would be things such as trucks and the like that need to be used in the business. Less $10,000 worth of depreciation because you've used it for a period of time. So in total, the business has $100,000 of assets. So now let's move to the right-hand side here, and we're looking at at liabilities. So remember, liabilities is money that is owed to outside parties. Okay. So in this particular case here, we have accounts payable, which means you're going to have to pay out to your suppliers $30,000. We have a bank loan payable, which is how much has to be paid this year to the on the bank loan itself. Okay, so total current liabilities means that you have to satisfy $35,000 worth of cash that's got to go out the door to cover your current liabilities. The long-term liabilities is basically your bank loan that is not due to be paid this year. So the pieces, so if you took out a 5-year loan for $30,000, $5,000 has to be paid this year. The other $25,000 is going to be paid over the next 5 years in various, it may be equal amounts. So if it was equal amounts, and let's boost it up. Let's say it was $100,000, you had to pay $20,000 per year. $20,000 has to be paid in the current year, so that's what would be in the bank loan payable, and $80,000 would therefore be in bank loan payable. In this particular company, we've got long-term liabilities of bank loan payable of $25,000, which means that is your total liability. There's nothing other long-term debts that are needed to be paid. So total liabilities is the sum of the two, the $35,000 plus the $25,000. This brings us to the other part on the balance sheet, which is the owner's equity. So this shows the value of the owner's investment in the business. So in order to start up the business, in this particular case, they had to put in $30,000. Okay. It may be not more than one owner, so there could be other investors who put money in there. But think of it in terms of this is money that is owed back to the owner. Now, as well, just to complicate things, there's other terms that can be used instead of just owner equity. It can also be called shareholders' equity. It can be called proprietor's capital. It can be called partner's capital. But what the key part is, it's owed to outside the firm to whoever established the firm, or in this particular case, we also have profits that have been earned that have not yet been paid out. Okay? It is not the value of the business. Remember, we talked about that earlier, is that the value of the business may be different than merely what owner equity is. The terminology will vary depending on whether the financial statements are an incorporated business or an unincorporated business. So be aware as well, you can also have a non-for-profit organization, and in non-for-profit organizations, these statements are going to be slightly different. So for now, we're going to focus on a for-profit organization, or an attempted for-profit organization. So a regular business, small business, or large. Now the owner's equity also includes an entry known as retained earnings. Retained earnings is an accounting term. It's sometimes confusing outside of financial circles, but again, it's one that you should understand. It's created via an accounting entry. Essentially, it's the cumulative profits since the company started that have not been paid out to the owner. When it is paid out to the owner, it's usually paid out as dividends. The concept is simple. If the company makes a profit, the profit is either returned to the owners in the form of dividends, or is kept inside and used to expand the business. So if it's kept inside, it's called retained earnings. So think of it, it's retained within the business or obtained by the owners, right? It's obtained or reduce the retained earnings, okay? And again, it is not the value of the business. This slide shows an example of a complete balance sheet for XYZ company on, say, December 31st of whatever year. And again, this can be prepared quarterly or even monthly. The assets on the left side of the balance sheet balance with the liabilities and owner's equity on the right side of the balance sheet. That's why it's called a balance sheet. So in this particular case here, we have total assets of $100,000 total liabilities, and total owner's equity of $100,000, and they balance. If they don't, there's an error made somewhere in the financial statements themselves. So understanding cash flow. So cash flow is obviously tremendously important to a business. A business pays its bills with cash, and without sufficient cash flow, the business will fail. The role of this statement is to show where the cash flow is coming from and where it's going, as well as the cash received during the period, right? So it's one thing to say, I have a balance sheet and here's what I have as a snapshot. This will show what happened during that period of time between the last balance sheet and the first and the current balance sheet. The cash flow statement looks very much like a checking account, so you can actually reconcile back to it. If you start with the cash at the beginning of the period, you have cash flows in, cash flows out, and the cash at the end. So it's good, obviously, to have more than when you started with, and it's really bad if the cash balance becomes negative. That means you're going to have to go get a cash infusion of some sort. Either the shareholders had to put in more equity, or you had to go and borrow. Okay? The cash flow statement is also sometimes called that sources and uses statement. As part of this exercise, you want to engage the audience because it's really critical that people understand the difference between cash flow and profits. And in most cases, they will think that cash is much more important than profits. But regardless of which way, you want to have a bit of active participation here. So you ask them to, as a lead into the slide, once you put the slide up, to give a show of hands. How many people think that cash flow is more important than profits? And then ask how many people think profits are more important than cash flow. So understanding the cash flow statement, let's just move now to the operating cash flow. A business can obtain cash from multiple sources. Obviously the operation of the business, the sale of the business, it's sale of the products or sale of the service generates cash. But it can also come from investors or from lenders or from the sale of assets. Only operating cash flow is considered to be sustainable. That is, again, in our example, we had the sale of a vacant land that generated cash, but that's a one-time event. So we're looking at what is the primary operating revenue of the activity of the business and what cash comes in from that. A profitable company will generate cash flow from operations, and the operations cash flow comes from the sale of products and the sale of services. In contrast, the financing and asset activity comes from lenders, investors, or from the purchase and sale of assets. Financing and asset cash flow can be thought of as infrequent events, hopefully, if the business is working fine. The purchase and sale of assets is when you may do such a thing as you need new trucks for the operation. And you need 5 new trucks at $100,000 a truck, so you go and borrow the money in order to buy the trucks. So you'll see a line item coming in saying from lenders, financing from lenders, and then you'll see the money coming out as purchase of assets. Okay. Now, if you have enough cash within the company, you don't have to have the financing coming out from an independent third party. It can be from existing operations, and it'll be a mere deduction then onto the cash flow. So you'd have starting cash flow a lot, let's say $500,000, $550,000. Purchase of trucks is $500,000. Therefore, it reduces your cash flow by that $500,000, and that's what you're trying to see within the statement itself. Often, the financing and asset activity are rare. So, if you're replacing trucks every 5 years, you'd see that activity take place on that financial statement. So let's continue through here. Operating activity cash flow is a recurring cash flow that keeps the business alive. It includes cash sales, includes credit and debit cards, as well as payments from its customers. So remember that you had accounts receivable. Well, when those accounts receivable turn into cash, that will be a cash flow in. Okay, financing and asset activity cash flow are infrequent events, as we mentioned. So taking out money, a loan to purchase equipment, of course, would be a financing activity, and then the loan proceeds will show us financing cash coming in to the company itself. Likewise, a company may sell some assets, such as a used truck, and that cash would come in again as a one-time recurring event. In the example we're showing above, you show the cash flow shows a $40,000 of cash generated from operations, okay, because we had sales of $5,000, we have credit and debit card collections at $10,000, and customer payments on the accounts receivable $25,000. Then we had an additional $75,000 generated from a loan, so money was borrowed by the company, and some additional investment, so owner's equity tossed in money for total cash coming in from those activities of $115,000. The use of the financing cash flows is explained on the next slide. So here, when a business is operating, it needs to pay its suppliers, its workers, other operating expenses. In our example on the screen here, we can see a business is paying out $30,000 of these expenses. In a prior slide, we saw a $50,000 bank loan coming in, plus $25,000 of additional owner's investments. And we see that this was used to purchase more trucks in this case, or a new piece of equipment. And that's why you're seeing asset purchases as $75,000 here. So I'm going to hand out to you now a cash flow statement for a different company called Flash Cow. And so it'll be distributed here as my volunteers working with me pass it out to each of you. I'm going to ask each of you in the audience to turn to somebody next to you and have a discussion about how that statement that's being passed out to you, that cash flow statement, differs from the one that's showing on the screen here. And what we're trying to show is different companies have different cash flow items or different proportions of operating activity, different challenges. So a company that is in the high-tech business, for example, would have, asset purchase would be relatively little, right? So in the case of, a company, let's use an example in real life. General Motors has a lot more plant and equipment than Microsoft does. Why? Because Microsoft is dealing mostly with gray matter in order to generate the software, and the actual value of the software is not necessarily the same as the value of the property, plant, and equipment that General Motors has. Okay, so each of these companies will have a different cash flow because they have different asset requirements, they have different ways of operating. So in this case here, what you're trying to do is show the audience a different cash flow statement so they can understand that this is not a rigid and consistent across all companies series of statements, that is going to vary dramatically by the industry that these companies are involved with, as well as the specifics of the company itself. So this is the complete cash flow statement. Now on the left, you can see that cash received from operating activity consisted of cash sales, credit and debit card collections, plus customer payments for accounts receivable. Total there was $40,000 came in from operating activity. The cash paid out for operating activities on the right side, payments to suppliers, workers' salaries, and operating expenses. Total operating activity, $30,000 went out the door. Okay, so we understand that. So now let's look at Flash Cow. So this is the illustration I passed out earlier. So we're seeing here that total cash received is $120,000 during the period. Total cash paid out is $201,000. So they began with zero cash. What would the cash be at the end of the period? So obviously it's going to be a minus $81,000. Now, if you had a company in this circumstance, should you be concerned as a business owner? And the answer is yes. And what strategies would you go through in order to mitigate, in order to solve this problem? Well, you could either increase the owner's investment, or you could go and borrow more within the business. Now, if you're going to go borrow more, this is where the bankers come in and are going to say, well, you're down $81,000 for this period. What assurances do I have that you're going to be able to pay this money back? And that's part and parcel why you want these financial statements, not only to measure where you are with the business itself, which obviously has to be called into question, because if you continue to pour in your own money, you have to know for yourself whether you're going to get it back. but any lender or other shareholder will want to know the same thing. So at this point, again, we're trying to engage the audience. We're trying to show them what different statements can look like. And part of it is that you can explain that in early startups, which looks like what Flash Cow is, it's not unusual to have no cash at the beginning because basically you're starting the company from scratch, and that it would require shareholder input and or loans in order to get the company through the first number of years. It's not unusual for a business to go 3 to 5 years initially without making any money until such time as it builds up its customer base and the like. So you want to illustrate this is in comparison to our XYZ company, which may be a more established firm. So why cash and profit are not the same thing? So why is it that the bank account is not showing the same number that your profit and loss statement is showing? Why are these two things different? Well, the first thing is, when is it you're recording your revenue? So revenue is recorded when the customer makes a purchase, okay? While cash is recorded when the payment is made. So think of credit cards, for example, or 90-day financing would probably be a better illustration. So if your customer purchases a particular product, but they have 90 days to pay for it, your cash is not going to be impacted until it's actually paid sometime in that 90-day period. The second key difference is that expenses are recorded when the service has been used or when something has been purchased. But you have financing on that bill as well. So again, that'll become your accounts payable. And any business that doesn't pay on the same day that when an expense is incurred will have a lag there. So there is a difference then as to when the cash comes in the door and the cash goes out the door, as opposed to revenue generated and expenses paid. And that's a real key point when it comes to sources and uses of cash. Financing activity and asset activity affect the balance sheet, but not the profit and loss statement. So remember, not all cash flow activities reflected on the profit and loss statement. If you have funds received from an owner or from lenders, that'll affect the balance sheet and it'll affect the cash flow statement, but not the profit and loss. Just because you got a loan of $100,000 doesn't mean your profit went up by $100,000. Just because you got an investor put in an extra $100,000, it'll go in the bank account, it'll increase the cash, but it has no effect on the profit or any loss that has occurred. So financing and asset activity very often have to do with the purchase of assets used by the business, which are treated as long-term activities rather than affecting current profits and losses. This brings us to resources. So we have an extensive amount of resources to pass out to you. Probably one of the best is the glossary of terms. So this is the language of accountants that we accountants speak back and forth to each other, that we discuss with bankers, that we discuss with the Canada Revenue Agency. So we're going to pass you out these glossary of terms, plus an implementation checklist. So this will be available to you. It's also available on our website as well. And with that, thank you very much for your attention. At this time, we'll open it up for questions. Remember, there's no such thing as a silly question. This is money. This is the investment of your time and in your future. So by all means, please let's have an open and free discussion. And with that, thank you very much. So one thing that we really need to emphasize when it comes to this jargon-filled industry that we are in, jargon is used for two purposes. One is to intimidate, quite frankly. That is, that when people ask a question, if you reply in jargon, you'll often shut down the whole communication process. So we had to recognize that we use jargon because it's a shortcut to get information across to each other. But many people in this type of an audience come from backgrounds that are completely different, or often blue-collar workers or people who have come from the trade side of the business, because quite frankly, that's where many small businesses are arising from, and they are intimidated to begin with. So it's very important to emphasize that there is no such thing as a silly question, that if you do say something that is a jargon-filled statement, I mean, things such as capital cost allowance, that throws people. When you explain that it's the technical CRA term meaning depreciation, sort of, but not exactly, you need to break it down and make sure that your language is as simple as possible. And if you have a guest speaker that's with you, or somebody else who's contributing, if you pair up to do these type of presentations, then you can kind of police each other. So in the event that a jargon term does slip out, that you can counsel each other to break it down into English and small words.